Imagine waking up, checking the morning data, and, well, seeing wholesale inflation hit a scorching 6.0%.
Which is just a massive number.
Exactly. Normally, that is the exact kind of macro nightmare that sends Wall Street running for the hills, aggressively hitting the sell button across every major index.
Oh, for sure. It usually causes pure panic.
Yeah, but now imagine watching the NASDAQ completely shrug it off, surging higher while the traditional economy basically suffocates.
It is wild to watch.
Way. Well, because the architects of the AI revolution are literally jetting off on Air Force One to reshape global trade. Welcome to our daily deep dive. I'm Daniel.
And I'm Mira. Today is Wednesday, May 13, 2026, and we are unpacking one of the most bizarre dichotomies we have seen in modern markets.
We really are.
We are going to break down the massive global energy shocks that are actively cementing this inflation, the intense reaction from central banks, and, the high-stakes AI and trade narratives that allowed tech bulls to power straight through all of that macro gloom.
But before we jump into the numbers, we want to give a quick reminder that this deep dive is for market context and discussion only.
Right. It is not personal investment advice or an investment recommendation.
Exactly. Okay, let's start from the top. So what set the stage before the U.S. session?
Well, the baseline for today's trading was actually firmly established before New York even woke up.
Yeah, driven entirely by the global energy agencies.
They really dropped some heavy data.
Yeah.
Right at 4:01 a.m. Eastern Time, the IEA and OPEC released their monthly reports, and the underlying math they presented is, frankly, devastating for the global economy.
I mean, the numbers are huge.
Unbelievably huge. The IEA estimates a staggering 12.8 million barrel per day global supply loss.
Wow.
Yeah, and that is resulting directly from the closure of the Strait of Hormuz since February.
Which, as a reminder, is intimately tied to the U.S.-Iran war and Operation Epic Fury.
Correct. And looking further ahead, the IEA predicts a massive 3.9 million barrel per day supply fall for the entirety of 2026.
We really need to pause and contextualize that 12.8 million barrels a day figure for everyone listening, because that is not a rounding error.
No, not at all.
That is a colossal chunk of the physical energy required to keep the modern world running.
Literally just removed from the global chessboard entirely.
Exactly. And just to give you some prior session context here, going into today, markets were already, digesting yesterday's severe warning from the U.S. Energy Information Administration.
Right, the EIA.
Yeah, the EIA noted that these war-related shut-ins are peaking at 10.8 million barrels per day right now in May.
And their core message was that this extended blockade is essentially locking in structurally higher energy costs.
For the foreseeable future.
Exactly. The physical constraint is undeniable. But what's fascinating here is the sudden divergence in the broader data.
What do you mean?
Well, while physical supply is utterly devastated, OPEC actually came out today and slightly downgraded its near-term global oil demand growth.
Oh, interesting.
Yeah, so you have this highly volatile picture, a massive physical supply constraint colliding with a downward revision in expected demand.
Wait, let me actually push back on that for a second to help make sense of this for the listener.
Sure.
If the Strait of Hormuz is closed and we are missing upwards of 12.8 million barrels a day, how does a slight demand downgrade by OPEC even matter?
That's a good question.
Are they anticipating a global recession, or is the intensely high price of oil simply destroying demand because businesses literally can't afford to operate?
It is absolutely the latter, which is classic demand destruction.
Right.
When energy costs spike this aggressively, factories have to reduce shifts, global shipping routes consolidate, and, consumer discretionary travel just plummets.
Yeah, that makes sense.
OPEC is looking at the skyrocketing prices and recognizing that the global economy simply cannot consume the same volume of oil at these elevated price points.
Which really cements the severity of the supply shock, because it shows the pain is already altering global consumption behavior. And when we look at the geopolitics actively driving the supply shock, it is incredibly easy for markets to react as if the Middle East conflict is just this unpredictable natural disaster.
Like something out of everyone's control.
Right. But we really need to view this through the framework of geopolitics as game theory brinkmanship.
Oh, for sure.
It is calculated leverage. Both sides are making highly specific moves to maximize their negotiating power.
That is exactly right. And if we pull in some prior session context, you see that game theory playing out perfectly in real time.
How so?
Well, Iran recently laid out 5 hard preconditions for returning to the negotiating table.
Okay.
And that crucially included a demand for compensation for war damages.
Yeah.
In direct response to that, President Trump explicitly threatened that Iran will either make a deal or, quote, be decimated.
Wow. So neither side is acting irrationally. They're just staking out maximalist positions.
Exactly. The rhetoric itself is a tool to test the opponent's breaking point before any actual diplomatic concessions are made.
It is brinkmanship in its purest form. Now, speaking of sudden policy moves that caught the market off guard, I want to pivot to a highly specific narrow market move.
Yeah, this one is particularly relevant for the commodities and metals subset of our listeners.
For sure. Late last night, specifically at 11:431 p.m. Eastern Time, the Indian government abruptly hiked import tariffs on gold and silver.
And this is, well, it's a textbook example of how a localized policy decision can instantly distort global pricing mechanisms.
Totally. Because you have to understand that India is one of the world's absolute largest consumers of physical precious metals.
So when this tariff hike hit, it acted as an immediate, massive barrier to entry for that physical supply.
Right. And the localized reaction was just explosive, wasn't it?
It really was. Local Indian futures surged 6% to 8%.
That's huge.
Yeah, and Indian gold ETF jumped over 5.5% as domestic buyers scrambled to secure whatever metal was already inside the country's borders.
It is essentially like throwing a massive dam across a raging river.
That's a great way to put it.
The water level surges wildly on one side of the dam that is the Indian domestic market, but it drops significantly on the other side.
Right, because this new tariff suppresses physical import demand from such a massive, historically consistent buyer.
Exactly. The international spot market suddenly felt a distinct lack of demand.
And as a result, international spot gold actually fell 0.6% to $4,686.99 per ounce.
So you have a globally dominant energy baseline and highly specific geopolitical and trade tensions firmly set in place before New York even woke up.
Which is a lot to digest before the bell even rings.
We're going to take a quick break, but coming up, what moved markets during U.S. trading hours?
So what actually moved markets during U.S. trading hours?
Well, the absolute dominant domestic driver hit the wire right at 8:30 a.m. Eastern Time with the U.S. Producer Price Index, or PPI, release.
And the numbers were scorching.
They really were. Wholesale prices surged 1.4% month over month.
Which is just an aggressive monthly jump. It pushed the year-over-year wholesale inflation rate to an eye-watering 6.0%.
6.0%.
Yeah. And importantly, it wasn't just the volatile categories like food or fuel causing the spike.
Right, because core PPI massively beat expectations as well, coming in at 1.0% monthly and 5.2% annually.
And this perfectly connects to the prior session's data.
Yeah.
Because just yesterday, we saw a hot April consumer price index print showing headline CPI up 3.8% year over year.
Right. So this new PPI data today is essentially forcing markets to stare down a much harsher, higher for longer interest rate reality.
Absolutely.
Let's unpack the mechanics of this for a second. What does a 6.0% wholesale inflation rate actually look like for a business?
Well, it means the raw materials required to build a server rack, manufacture a car, or, stock a retail shelf.
Just got significantly more expensive overnight.
Exactly.
We often talk about this framework of energy shocks as a delayed consumer tax, right?
We do.
And this is exactly what that looks like in practice. I mean, these 6% wholesale cost increases, they don't just, vanish into the ether.
No, they definitely don't.
They are going to ruthlessly squeeze the profit margins of non-energy corporations.
And then those corporations will have literally no choice but to pass those elevated costs onto you, the consumer, at the register in the coming months.
And the Federal Reserve is watching this delayed tax mechanism very closely.
They absolutely are. They know that if these wholesale costs bleed into the broader consumer economy, their inflation fight is in serious jeopardy.
Right. And we saw that concern directly today. At 11:30 a.m. Eastern Time, Fed officials Susan Collins and Neil Kashkari delivered some very hawkish, highly coordinated warnings.
Yeah, Collins stated bluntly that the Fed may actively need to hike interest rates if price pressures continue to broaden beyond just energy inputs.
Which is a strong statement.
It is. Meanwhile, Kashkari pointed out that the labor market is currently moving sideways. And he heavily emphasized that the Strait of Hormuz closure has entirely upended the domestic inflation environment.
Which brings in the critical concept of central bank credibility as an inflation anchor.
Exactly. The Fed is deliberately deploying this hawkish messaging right now to prioritize inflation control over near-term economic growth.
They know that if consumers and businesses start believing that 6% wholesale inflation is just the new normal,
behavioral expectations become completely unmoored.
right, they are telling the market loud and clear that imminent rate cuts are completely off the table.
And to add literal fuel to that inflationary fire, at 10:30 a.m. Eastern Time, the EIA reported a massive draw in domestic commercial crude inventories.
We saw a draw of 4.3 million barrels alongside a striking 4 million barrel plunge in domestic gasoline stocks.
The U.S. energy squeeze is very real and accelerating. Consequently, XLE, the energy sector ETF, closed up slightly on the day.
But, if you are listening to this, looking at your skyrocketing gas bill and hearing multiple Fed officials threaten more rate hikes,
You are probably extremely confused by the broader market indices today.
exactly. Because here's where the narrative gets truly fascinating. With 6% wholesale inflation, hawkish central bankers, and massive domestic oil draws, why on earth did the NASDAQ rally 1.20% today?
It's the ultimate paradox.
Right. And how did S&P 500 futures, ES equals F, climb to a high of 7,475,575? I mean, Wall Street seems to be living in a totally different universe than Main Street right now.
It really does. And it all comes down to a massive, unprecedented catalyst that broke overnight and completely dominated the psychology of U.S. trading hours.
The Air Force One trip.
Yes, President Trump flew on Air Force One to Beijing for a high-stakes diplomatic summit. But he wasn't traveling alone.
No, he brought some very interesting guests.
He was accompanied directly by NVIDIA CEO Jensen Huang and Tesla's Elon Musk.
Which is just, an incredible visual to imagine,
Fair share.
You have the President of the United States and the literal architects of the artificial intelligence hardware boom stepping off Air Force One in Beijing together.
It's historic. They're currently weighing massive tariff cuts on up to $30 billion of imports, explicitly aiming to de-escalate ongoing trade tensions.
And in parallel to this, U.S. Treasury Secretary Scott Bessent is holding strategic, high-level talks with Chinese Vice Premier He Lifeng.
Which is huge for the broader tech sector. They rely profoundly on frictionless global hardware supply chains to build these AI data centers.
So the prospect of targeted tariff relief is a massive fundamental tailwind.
Absolutely.
I have to play devil's advocate here, though.
Very fair.
Is the market completely ignoring the macro reality? We frequently see the dynamic of macro narratives blinding micro resilience, but today it feels entirely reversed.
Yeah, it really does.
Investors are practically plugging their ears, ignoring rising interest rates and 6% wholesale inflation, and choosing instead to aggressively ride the micro resilience of the AI megatrend and the mere potential of these trade deals.
Right.
Is this Air Force One trip actually going to solve the structural inflation we just talked about, or is it just a shiny object for tech investors?
Well, it won't solve the inflation, but for tech investors, it might not matter in the short term.
Interesting.
It is a remarkable tug of war. On one side, you have the grim physical reality of sticky inflation and a hawkish Fed determined to slow the economy.
Yeah.
On the other side, you have unbridled tech optimism, fueled by the possibility of unburdened supply chains and unceasing AI growth.
And today, the sheer momentum of tech optimism won that battle decisively.
It certainly did. The sheer gravity of the AI narrative continues to warp traditional market logic.
It really does. All right, let's take a quick breather, and when we come back, what were the key corporate events and what do we watch next?
So we've talked about the macro picture. What were the key corporate events and what do we watch next?
Well, the specific corporate events today perfectly illustrate the aggressive, almost desperate AI optimism we just discussed.
Oh, definitely.
Let's start with Anthropic. News broke before U.S. trading, specifically at 5:13 p.m. Eastern Time yesterday, that the AI startup is officially seeking $30 billion in new funding.
And if successful, this funding round would put Anthropic at a mind-bending $900 billion valuation.
$900 billion.
It is almost hard to conceptualize that number for a startup.
I mean, that valuation makes them larger than the vast majority of established, century-old legacy companies in the S&P 500.
It really does. And this valuation momentum strongly drove the broader tech sector today, with the tech ETF, XLK, closing up 0.94%.
This perfectly encapsulates the framework we see of AI capex as a cycle-agnostic arms race.
Exactly. Let's break that down. Normally, if inflation hits 6% and borrowing gets incredibly expensive, companies immediately cut back on capital expenditures.
Right, that's business 101.
But with AI, a CEO at Microsoft or Anthropic isn't looking at interest rates. They're looking at survival.
Yeah. If they don't spend billions now to secure their position in the AI hierarchy, they view it as an existential threat.
The macroeconomic cycle simply doesn't matter to them. They have to spend the money regardless.
And Anthropic is moving aggressively to deploy that capital.
They are. They're currently in advanced talks to buy the developer tool startup Stainless for $300 million.
Furthermore, they are rapidly expanding their enterprise footprint globally.
Right. Major Japanese financial institutions just gained official access to Anthropic's Claude AI model, highlighting their global reach.
But Anthropic isn't the only one throwing around mind-boggling numbers today.
No, they are not. At 12:48 p.m. Eastern Time today, a Reuters report tied to Elon Musk's ongoing OpenAI lawsuit revealed something massive.
Something massive about Microsoft's internal balance sheet, right?
Yes. The report officially revealed that Microsoft has spent more than $100 billion on its OpenAI partnership.
$100 billion. I mean, that is just staggering.
It is. That figure includes direct equity investments, building out the physical infrastructure, and the immense cloud hosting costs.
It perfectly quantifies the almost unfathomable capital required simply to play in this space right now.
Absolutely. But crucially, the report also noted that Microsoft is now actively exploring other AI startup deals.
Basically, to diversify away from single partner risk.
Right.
It's basically like Microsoft built a $100 billion digital mansion, but suddenly realized, wait, we don't actually own the land it sits on.
That is a great analogy.
Now they're frantically buying up neighboring lots and striking new deals just in case their primary landlord, OpenAI, becomes a liability.
They are acknowledging that relying entirely on one partner is a structural vulnerability, despite the massive sunk cost.
Moving away from the tech sector for a moment, we also had a major corporate-level event for the U.S. economy itself today.
We did.
At 2:35 p.m. Eastern Time, the Senate officially confirmed Kevin Warsh to lead the Federal Reserve, permanently replacing Jerome Powell.
This transition brings some much-needed institutional certainty to the markets regarding monetary policy continuity.
However, the markets widely view Warsh as a highly hawkish, deeply inflation-focused chair.
Interestingly, though, the 5-year Treasury yield actually dipped slightly today, down 0.01 percentage point to 4.111%.
Yeah, you might normally expect yields to rise on a hawkish confirmation.
Right. But the market digested this certainty alongside the broader inflation data and seemed relieved to simply have the leadership question permanently settled.
Well, to perfectly summarize the absolute whiplash of today's market, where we literally bounce between a devastated physical oil market and $900 billion AI startups, I have to read you today's dedicated closing bell joke straight from our source materials.
Let's hear it.
It goes like this. Well, that's the closing bell, folks, and what a uniquely 2026 day it was.
Oh, boy.
We had wholesale inflation hit 6%, which usually means the Fed is going to take away the punch bowl.
Right.
But investors saw Jensen Huang and Elon Musk board Air Force One to Beijing and decided AI trade deals matter more than expensive groceries.
That is painfully accurate.
It continues, congratulations to the tech bulls who survived Kashkari's hawkish warnings by simply hiding behind Anthropic's new $900 billion valuation.
Incredible.
Just remember, while your NASDAQ portfolio is hitting new highs, your gas tank is still basically filing for Chapter 11 bankruptcy.
I mean, it's funny because it's true, right? It is a painfully accurate summary of the disconnect between Wall Street and Main Street today.
It really is. So what do we have to look forward to? What is on the docket for tomorrow?
Looking ahead, we have a dense docket. Here is what to watch next for tomorrow, Thursday, May 14.
Okay, what are we looking at?
At 8:30 a.m. Eastern Time, we get a major demand and inflation check.
The retail sales data.
Exactly. April retail sales, core and control sales, import and export prices, and jobless claims.
That's a lot for 8.30.
It is. Then at 9 a.m. Eastern Time, we see business and retail inventories.
Okay, what else?
At 9:30 a.m. Eastern Time, the EIA natural gas storage report drops.
Got it.
At 10:30 a.m. Eastern Time, we have the 4-week and 8-week Treasury bill auctions.
Big thing on the Fed side.
Yes, actually. Plus, we will be closely watching the Kansas City Fed Future of Banking Conference.
Right, because there's some big speeches there.
Yeah, it features highly anticipated speeches from President Jess Schmid and Vice Chair Michelle Bowman.
It is going to be a heavy day-to-day tomorrow to see if this consumer resilience can actually hold up against the delayed tax of 6% wholesale inflation.
Exactly. And, to leave you with a final thought to mull over as we wrap up today's session.
Yeah.
With tech giants actively mediating international trade policy straight from Air Force One, while the traditional physical economy suffocates under 6% wholesale inflation and historic energy bottlenecks.
It's quite the contrast.
It is. Are we currently witnessing the final irreversible decoupling of the digital AI economy from the physical, energy-constrained world?
That is a fascinating question. Let us know in the comments if you think the AI trade can outrun the Fed's inflation fight.